Hello and welcome back to our GST lecture series. I'm delighted to have you join me for this second chapter, where we'll dive deep into one of the most fundamental concepts in GST, understanding supply. In our previous lecture, we established a solid foundation about what GST is and why India needed this tax reform. Today, we're going to explore the heart of GST, the concept of supply. This is absolutely crucial because in GST, everything revolves around supply. If you understand supply correctly, you've mastered half of GST. By the end of this lecture, you'll have complete clarity on what constitutes a supply, what doesn't, and how different types of transactions are treated under GST. So let's begin this exciting journey into the core mechanics of GST. Before we dive into the details, let me outline our comprehensive agenda for today's session. We'll start by understanding what constitutes a taxable event under GST and why this concept is so important. Then we'll explore the meaning and scope of supply. This is where we'll understand the legal definition and boundaries of what GST considers as supply. Next, we'll examine transactions that are considered as supply even when made without consideration. These are special cases that GST law specifically includes. Following that, we'll look at non-supply transactions, activities that are explicitly excluded from GST. We'll then discuss the classification of specified transactions as either supply of goods or supply of services. This is crucial for determining tax rates and compliance requirements. Finally, we'll explore composite and mixed supplies. These are complex scenarios where multiple supplies are bundled together, and understanding their treatment is essential for businesses offering multiple products or services. Let's start with a fundamental concept. What is a taxable event? A taxable event is any transaction or occurrence that triggers a tax liability. Think of it as the moment when the tax meter starts running. Identifying the taxable event is absolutely essential because it determines the exact point at which tax becomes due. Now, here's something interesting. Different tax systems have different taxable events. For instance, in income tax, earning income is a taxable event. In customs duty, importing goods is a taxable event. But in GST, the taxable event is called supply. This is a departure from our previous indirect tax system, where we had different taxable events for different taxes. Manufacturing for excise duty, sale for VAT, and providing services for service tax. GST has simplified this by making supply the single taxable event for all goods and services. Whether you're manufacturing, trading, or providing services, the moment you make a supply, GST kicks in. The scope and definition of supply is comprehensively detailed under Section 7 of the CGST Act 2017. This section is like the foundation stone of the entire GST structure. Understanding Section 7 is crucial for anyone dealing with GST. Now let's look at the legal definition of supply as given in Section 7(1) of the CGST Act 2017. This definition is quite comprehensive and covers various scenarios. Supply includes all forms of supply of goods or services or both. Notice the phrase all forms. This means GST casts a wide net. It's not just about selling. It includes sale, transfer, barter, exchange, license, rental, lease, or disposal. So whether you're selling a product, renting it out, or even giving it on lease, all these constitute supply. But there are three important conditions. First, these activities must be made or agreed to be made for a consideration, meaning there should be some payment or exchange involved. Second, they must be done by a person in the course or furtherance of business. Casual, personal transactions don't qualify. However, the law also includes two important exceptions. Import of services is always considered supply, whether or not it's in the course of business and whether or not for consideration. This ensures that service imports are always taxed. Additionally, certain activities specified in Schedule 1 are treated as supply even when made without consideration. We'll explore these special cases in detail later. This definition shows how GST has expanded the tax net compared to the previous system, ensuring that most commercial activities are captured under its scope. Let me break down the three essential parameters that generally determine whether something qualifies as supply under GST. The first parameter is that supply must involve goods or services or both. This seems obvious, but it's important because anything that's neither goods nor services falls outside GST scope. The law provides clear definitions for what constitutes goods and services, which we'll discuss shortly. The second parameter is that supply must be made for consideration. Consideration means some form of payment or exchange. It could be money, goods, services, or even a promise to do or not do something. The third parameter is that supply must be made in the course or furtherance of business. This distinguishes commercial activities from personal transactions. If I sell my personal car to my neighbor, it's not a supply under GST because it's not during business. However, as I mentioned earlier, there are important exceptions to the second and third parameters. Import of services is always considered supply, regardless of whether it's for consideration or during business. And Schedule 1 activities are treated as supply, even without consideration. These parameters work together to create a comprehensive framework for identifying taxable supplies under GST. Let's understand what GST considers as goods, because this forms the foundation for determining whether GST applies to a particular transaction. According to Section 252 of the CGST Act, goods means all movable property other than money and securities. This definition is quite broad and encompasses most physical items that can be moved from one place to another. The definition specifically includes three important categories. First, actionable claims. These are legal rights to claim money or property. For example, insurance policies, bank deposits, or shares in companies. However, not all actionable claims are taxable under GST, only those that involve consideration for goods or services. Second, growing crops and grass are considered goods, but only before they are harvested. Once you harvest the crop, it clearly becomes goods. But interestingly, even standing crops are treated as goods under GST. Third, things attached to or forming part of land are classified as goods if they are agreed to be severed before supply or under a contract of supply. This includes minerals, timber, or natural resources. The key point is that these items must be separated from the land as part of the supply. This broad definition ensures that most physical items and certain intangible rights are covered under the goods category, making GST applicable to a wide range of transactions involving movable property. Now let's understand what constitutes services under GST. The definition of services is elegantly simple yet comprehensive. According to Section 2(1)(2) of the CGST Act, services means anything other than goods, money, or securities. This is what we call a negative definition. Instead of listing what services are, it defines services as everything that goods, money, and securities are not. The definition specifically includes activities related to the use or conversion of money for which a separate consideration is charged. For example, banking services, foreign exchange services, or currency conversion services would fall under this category. It also includes transactions involving facilitating or arranging deals in securities. So, if you're a stockbroker helping clients buy and sell shares, the brokerage service you provide is clearly a service under GST, even though the underlying securities themselves are not goods. This comprehensive definition ensures that the entire spectrum of economic activities is covered under GST. If it's not goods and it's not money or securities, then it's a service and potentially subject to GST. Now let's understand that for a transaction to qualify as supply, it generally requires consideration. But what exactly do we mean by consideration? In simple terms, consideration means payment for something you receive. However, it's important to understand that this payment doesn't always have to be in money. It can also be in kind, meaning goods or services. The key feature of consideration is quid pro quo, which is a Latin phrase meaning something for something. This means that if you give something, you must get something in return. This exchange is what creates the taxable event under GST. For example, if I give you a service and you pay me money, that money is the consideration. But if I give you goods and you give me other goods in return, that's barter. Both the goods being exchanged serve as consideration for each other. The concept of consideration is what distinguishes commercial transactions from gifts or donations. When you buy something from a shop, you are providing consideration, money for the goods. When someone gives you a gift, typically there's no consideration involved, which is why gifts are generally not subject to GST. Now let's look at the precise legal definition of consideration as provided in section 231 of the CGST Act. According to this section, consideration includes any payment made in money or otherwise in respect of, in response to, or for the inducement of the supply of goods or services. Notice the phrase money or otherwise. This confirms that consideration can be in any form, not just cash. The definition also includes the monetary value of any act or forbearance related to the supply. Forbearance means agreeing not to do something you have the right to do. For instance, if a landlord agrees not to increase rent in exchange for the tenant maintaining the property, the landlord's forbearance is consideration. Here are some key points about consideration that you must remember. First, consideration may flow from the recipient of the supply or from a third party. So if someone else pays for your purchase, that payment still constitutes consideration. Second, subsidies provided by the central or state government are not considered as consideration. This ensures that government welfare schemes don't attract GST. Third, deposits are not treated as consideration unless they are applied towards payment for the actual supply. So a security deposit for renting a house is not consideration, but if it's later used to pay rent, then it becomes consideration. Finally, transactions without consideration are generally not treated as supply unless they are specifically deemed so under Schedule I, which we'll discuss later. Let me illustrate the concept of consideration with some practical examples that you'll encounter in real life. Example 1 is straightforward. A shopkeeper sells a packet of biscuits to a customer for 50 rupees. Here, the 50 rupees paid by the customer is clearly the consideration for the biscuits. This is a simple monetary consideration. Example 2 shows barter. A farmer supplies wheat to a carpenter in exchange for a wooden table. In this case, the wheat is the consideration for the table and the table is the consideration for the wheat. Both parties are providing consideration to each other in the form of goods. Example 3 demonstrates forbearance. A landlord agrees not to increase the rent for the next year in exchange for the tenant repairing the house. Here, the forbearance, that is, the landlord refraining from increasing rent, is the consideration for the tenant's act of repairing the house. The tenant's repair work is the consideration for the landlord's forbearance. Example 4 shows third-party consideration. A hotel provides banquet hall services for a wedding. Instead of the bride or groom paying, their family friend settles the bill. In this case, the consideration is provided by a third party rather than the actual recipient of the service. The GST law recognizes this as valid consideration. These examples show that consideration can take many forms: money, goods, services, forbearance, or even payment by third parties. The key is that there must be some form of exchange or quid pro quo. Let me share some special scenarios to help you understand when consideration exists and when it doesn't, because this directly impacts GST applicability. Let's start with donations to charitable institutions. Generally, pure donations without any expectation of return don't involve consideration, so no GST applies. However, if donations are made for business promotion purposes, like a company donating to get publicity or tax benefits, then consideration might exist and GST could apply. The second scenario involves artworks sent by artists to galleries for exhibition. If the artist is just displaying their work without any agreement for payment or sales commission, there's no consideration. But if there's an agreement that the gallery will sell the artwork and take a commission, then consideration exists. The third scenario is about no claim bonus offered by insurance companies. NCB is a discount given when no claim is made during the policy period. Importantly, NCB is not consideration because the insured person is not under any contractual obligation to avoid making claims. The insurance company offers NCB as an incentive, but it's not payment for any specific service from the insured. These examples highlight that determining whether consideration exists requires careful analysis of the relationship between the parties and the nature of the transaction. It's not always black and white, and the specific circumstances matter a lot. Now we come to a very important exception in GST law, Schedule 1. The schedule lists specific activities that are treated as supply even when they are made without consideration. This is GST's way of preventing tax avoidance through related party transactions. Let me explain each of these 5 categories. First, permanent transfer or disposal of business assets where input tax credit has been availed on such assets. For example, if a company bought machinery, claimed ITC on it, and later sells or disposes of it without consideration, it's still treated as supply. This prevents businesses from claiming ITC and then disposing of assets without paying GST. Second, supply of goods or services between related persons or distinct persons when made in the course or furtherance of business. This prevents companies from avoiding GST by transferring goods or services between related entities without payment. However, there's an important exception: gifts not exceeding rupees. 50,000 in value in a financial year from an employer to an employee are not treated as supply. Third and fourth relate to principal-agent relationships. When a principal supplies goods to an agent for further supply, or when an agent supplies goods to the principal, these are treated as supplies even without consideration. Fifth, import of services by a person from a related person or from any of his other establishments outside India in the course or furtherance of business is always treated as supply. These provisions ensure that the GST net cannot be avoided through related party transactions. When supplies are made without consideration under Schedule 1, a crucial question arises. How do we determine the value for GST calculation? After all, if there is no consideration, how much GST should be charged? The GST law provides a systematic approach to determine this value through three methods to be applied in sequence. Method 1 is the open market value of similar supply between unrelated entities. This means you look for what unrelated parties would pay for the same goods or services in the market. For example, if a company transfers goods to its subsidiary without payment, you'd look at what independent customers pay for the same goods. If method 1 fails to give a reliable value, then you apply method 2, the value of goods of like kind and quality. This involves finding goods that are similar in nature and quality, even if not exactly the same. If both the above methods don't provide an appropriate value, then method 3 comes into play, a value based on cost or under the residual method. This could be the total cost of production plus a reasonable margin or any other method prescribed by the government. This systematic approach ensures that Schedule 1 supplies are valued fairly, preventing undervaluation, while also ensuring that the valuation is reasonable and based on market realities. Let's understand another crucial parameter for determining supply, the requirement that the activity must be undertaken in the course or furtherance of business. This phrase is key to distinguishing between commercial activities that attract GST and personal activities that don't. In the course or furtherance of business includes all activities carried out by any person during the course of running their business, as well as activities that would further the interests of the business. This is quite broad and covers not just direct business activities but also supporting activities. The CGST Act provides a comprehensive definition of business under Section 217. Business includes any trade, commerce, manufacture, profession, vocation, or even wager or betting, whether or not undertaken for profit. This is important. The profit motive is not necessary for something to be considered business under GST. Business also includes activities incidental or ancillary to trade or commerce. So if you're running a manufacturing business and you also provide transportation services to deliver your goods, that transportation is also part of your business. Interestingly, business even includes activities by the central or state government or local authorities when they are acting as public authorities. Here are some key insights. Business activities under GST don't require frequency, continuity, or pecuniary benefits to qualify as business. Even one-off or irregular transactions may be considered business activities if they meet the other criteria. This broad definition ensures that most commercial activities are brought under the GST net, preventing tax avoidance through claims of non-business activities. Import of services receives special treatment under GST law, and understanding this is crucial for businesses that receive services from abroad. Let me walk you through this decision tree that determines whether import of services constitutes supply. The first question is the import of service for consideration? If the answer is yes, then it's always treated as supply, regardless of whether it's in the course of business or not. This is different from domestic supplies, which must be in the course of business to qualify as supply. But if the answer is no, then we need to check the second question. Is it from a related or distinct person in the course of furtherance of business? If the import is for consideration, if the import is without consideration, then it's treated as supply only if it's from a related or distinct person in the course or furtherance of business. This aligns with the Schedule I provisions we discussed earlier. If both conditions are not met, that is, if it's without consideration and not from a related person in the course of business, then it's not treated as supply. This special treatment for import of services ensures that the GST net captures most service imports, preventing tax avoidance through offshore arrangements. It also ensures that businesses cannot avoid GST by receiving free services from their overseas related entities. While GST has a broad scope, there are certain activities and transactions that are specifically excluded from the definition of supply. These exclusions are mentioned in Section 7, subsection 2 of the CGST Act. There are two main categories of exclusions. Clause A covers activities specified in Schedule 3. These are activities that might otherwise look like business activities but are specifically excluded from GST. We'll examine Schedule 3 in detail in the next slide. Clause B covers certain government activities. These are activities or transactions undertaken by the central government, state government, or local authorities in their role as public authorities and specifically notified by the government based on recommendations of the GST Council. The logic behind these exclusions is that certain activities, while they might technically meet the definition of supply, serve important social, constitutional, or administrative functions that should not be subject to GST. For government activities, the exclusion applies only when they are acting as public authorities. If the same government entities engage in commercial activities competing with private businesses, those activities would be subject to GST. These exclusions are carefully crafted to ensure that essential public functions are not burdened with GST while maintaining the tax net for commercial activities. Let's examine Schedule 3, which lists activities that are specifically excluded from the definition of supply. These are called non-supplies, and understanding them is crucial. First, employee services. Services provided by an employee to their employer as part of their employment are not considered supply. This makes sense because the employment relationship is governed by labor laws, not commercial laws. The salary paid to employees is not consideration for supply of services under GST. Second, judicial services. Services provided by courts or tribunals established by law are excluded. This ensures that the judicial system can function without GST complications. Third, constitutional and government duties cover a broad range. This includes functions performed by members of parliament, state legislatures, panchayats, municipalities, and other local authorities. It also covers duties performed under the Constitution by individuals holding official positions and duties by chairpersons, members, or directors in government established bodies who are not considered employees. Fourth, funeral and burial services are excluded from GST. This includes crematorium and mortuary services, as well as transportation of the deceased. This exclusion is based on humanitarian grounds, ensuring that essential services related to death are not subject to tax. Fifth, sale of land and sale of buildings are generally excluded from GST, with some exceptions mentioned in Schedule 2, which we will discuss later. These exclusions reflect the policy decision to keep certain essential and sensitive activities outside the GST framework. Let me continue with the remaining categories of non-supplies under Schedule 3. Actionable claims other than lottery, betting and gambling are excluded from GST. This means that trading in shares, bonds, debentures, and other financial instruments is not subject to GST. However, the services related to these transactions, like brokerage, advisory services, or custodial services, are subject to GST. Cross-border goods movement covers supply of goods within non-taxable territory without such goods entering into India. This relates to transactions in special economic zones or free trade zones where goods move without entering the domestic tariff area. Supply of warehoused goods has two specific exclusions. First, supply of goods to any person before clearance for home consumption. Second, supply of goods by the consignee to any other person by endorsement of documents of title after goods have been dispatched from the port of origin outside India but before clearance for home consumption. These provisions ensure that warehousing operations don't create unnecessary GST complications. Insurance premium sharing covers premium apportionment between lead and co-insurers in co-insurance agreements, where taxes are paid by the lead insurer on the full premium. This prevents double taxation in complex insurance arrangements. Reinsurance services provided by reinsurers to insurers are excluded when taxes are paid by the reinsurer on the gross premium, including ceding commission. This ensures smooth functioning of the insurance industry. These exclusions demonstrate the careful consideration given to various sectors while designing the GST framework. Let me walk you through this comprehensive flowchart that summarizes everything we've learned about determining whether an activity constitutes supply under GST. We start by asking, is it supply of goods or services? If yes, we check, is it for consideration or if it's from related people in the course of business? If yes, then we need to verify it's not excluded under Schedule 3 or Section 7 2B. If it's not excluded, then it's a supply, and if it's excluded, then it's not a supply. But if it is not a supply of goods or services, then it's not a supply under GST. Now we check, is it import? If it's import of services, then it follows a different path, which we've already discussed. It is a supply if it's for consideration or if it's from related persons in the course of business. If not, then it's not a supply under GST. Now, if the supply of goods is not for consideration, we ask, is it an activity specified in Schedule 1? If yes, and it's in the course of furtherance of business and not excluded under Schedule 3, then it's treated as supply. If it doesn't meet the Schedule 1 criteria, then it's not a supply. This flowchart is like a decision tree that helps you systematically determine whether any activity constitutes supply under GST. I recommend you practice using this flowchart with different scenarios to build your confidence in identifying supplies. Now let's move to Schedule 2, which serves a different but equally important purpose. While Schedule 3 tells us what's not a supply, Schedule 2 helps us classify certain activities as either supply of goods or supply of services. Schedule 2 provides clarity on certain types of supplies where there might be confusion about classification. This is crucial because the classification determines the applicable GST rate, compliance requirements, and various other provisions. For example, works contracts involve both goods and services. Is it supply of goods or services? Schedule 2 provides the answer. Similarly, restaurant services involve both food, goods, and service. How should this be classified? Schedule 2 defines specific activities and categorizes them clearly, reducing ambiguity and ensuring consistent tax treatment across the country. This is mentioned in Section 7, 1A of the CGST Act. Let me take you through the key provisions of Schedule 2. The first category deals with transfer of goods. Transfer of title in goods is classified as supply of goods. However, transfer of right in goods without transfer of title is classified as supply of services. Transfer of title with future payment agreement is supply of goods. This distinction is important because it affects how the transaction is taxed and what compliance requirements apply. For businesses involved in complex transactions involving goods, understanding these classifications is crucial for correct GST treatment. Let me continue with more provisions of Schedule 2 that are particularly relevant for businesses dealing with real estate and processing services. For land and building transactions, Schedule 2 provides clear guidance. Lease, tenancy, easement, or license to occupy land is classified as supply of services. This makes sense because you're not transferring ownership of the land, just the right to use it. Similarly, lease or letting out of buildings for business or commerce purposes is classified as supply of services. Notice the specific mention of business or commerce purposes. This is important for determining GST applicability. The third category covers treatment or process applied to another person's goods. This is classified as supply of services. For example, if you send your cloth to a tailor for stitching or send your gold to a jeweler for making ornaments, the tailoring or jewelry making service is classified as supply of services, even though it involves working on goods. This classification is particularly important for job work and processing industries. Many businesses receive goods from customers, process or treat them, and return them. Understanding that this constitutes supply of services helps these businesses comply with GST requirements correctly. The classification also affects input tax credit eligibility, reverse charge provisions, and various other GST implications. Getting the classification right is therefore crucial for proper GST compliance. Let's examine the provisions related to business assets and various services under Schedule 2. For transfer of business assets, Schedule 2 provides detailed guidance on different scenarios. Transfer or disposal of business assets that are no longer part of business assets is classified as supply of goods. This typically happens when a business sells off its old machinery or equipment. However, use of business goods for private purposes or making them available for non-business use is classified as supply of services. For example, if a company allows its director to use the company car for personal purposes, this is treated as supply of services. When a person ceases to be a taxable person, goods forming part of business assets are deemed to be supplied, and this is classified as the supply of services. However, there are two important exceptions. When the business is transferred as a going concern to another person, or when the business is carried on by a personal representative who is deemed a taxable person. The fifth category covers various services. Renting of immovable property is supply of services. Construction of a building or complex for sale is supply of services, unless full payment is received after completion. This exception is important for the real estate sector. Temporary transfer or use of intellectual property rights is supply of services. Development, design, customization, or implementation of IT software is supply of services. This is crucial for the IT industry. Even agreeing to refrain from, tolerate, or do an act is classified as supply of services. This covers forbearance that we discussed earlier. The final category in Schedule 2 deals with composite supply, which is a very important concept in GST. Works contract, as defined in Section 2, the 19 of the CGST Act, is classified as supply of services. A works contract typically involves both goods and services. For example, a construction contract involves both materials, goods, and construction services. Despite involving both elements, Schedule 2 clarifies that works contracts are to be treated as supply of services. The second provision under composite supply relates to supply of food, beverages, or any other consumables, excluding alcohol, as part of any service. This is classified as supply of services. For example, when you go to a restaurant, you receive both food, goods, and dining services. Instead of trying to separate the two, Schedule 2 clarifies that the entire transaction should be treated as supply of services. This classification has significant implications for businesses in the hospitality and catering industry. It simplifies compliance by avoiding the need to segregate goods and services components in such transactions. This brings us to our next major topic, composite and mixed supplies, where we'll explore these concepts in much greater detail. Let's dive deep into one of the most important concepts in GST, composite supply. This concept is crucial for businesses that offer multiple products or services together. According to the GST law, composite supply means a supply made by a taxable person to a recipient consisting of two or more taxable supplies of goods or services, or both, which are naturally bundled and supplied in conjunction with each other in the ordinary course of business, where one of them is a principal supply. Let me break this definition down. First, there must be two or more supplies. It could be goods with goods, services with services, or goods with services. Second, these supplies must be naturally bundled, meaning they are typically sold together, not artificially combined just to get tax benefits. Third, they must be supplied in conjunction with each other in the ordinary course of business. Fourth, one of these supplies must be the principal supply, the main reason why the customer is making the purchase. The classic example is a mobile phone with its charger. When you buy a mobile phone, the charger comes with it naturally. Here, the mobile phone is the principal supply because that's what the customer primarily wants. The charger is a secondary supply that comes naturally with the phone. The customer is primarily buying the phone. The charger is an essential accessory that makes the phone functional. This is what makes it composite supply. The supplies are naturally bundled and there's a clear principal supply. Now let's understand mixed supply, which is different from composite supply, and this difference is crucial for GST treatment. Mixed supply means two or more individual supplies of goods or services or any combination thereof made in conjunction with each other by a taxable person for a single price, where such supply does not constitute a composite supply. The key difference from composite supply is that in mixed supply, there's no principal supply, and the items are not naturally bundled. They're just offered together, often for convenience or as a promotional strategy. The perfect example is a McDonald's combo meal consisting of a burger, fries, and a beverage. Here, each item is a distinct supply. The burger, fries, and beverage are all separate food items. They're offered together for a single price as a combo, but none of them is the principal supply. A customer might want the combo for various reasons. Maybe they like all three items equally, or maybe it's just convenient. Unlike composite supply, where the items are naturally bundled, like phone and charger, in mixed supply, the items are artificially bundled for commercial reasons. You could easily buy each item separately, and each has its own distinct purpose. This distinction between composite and mixed supply is not just academic, it has real tax implications. The GST treatment for composite supply is different from mixed supply, which we'll explore next. Now comes the crucial part. How are composite and mixed supplies taxed under GST? The tax treatment is different for each, and understanding this is essential for businesses offering bundled products or services. For composite supply, according to Section 8 of the CGST Act, the entire supply is treated as a supply of the principal supply. This means the GST rate applicable to the principal supply applies to the entire transaction. Going back to our mobile phone and charger example, if the mobile phone, which is the principal supply, attracts 12% GST and the charger normally attracts 18% GST, the entire composite supply will be taxed at 12% because that's the rate applicable to the principal supply. This simplifies the tax calculation tremendously and makes business sense too. Think about it logically. When you're buying a mobile phone, you're primarily interested in the phone itself. The charger is just an essential accessory that comes with it. You wouldn't buy the charger without the phone. So it's fair that the phone's tax rate governs the entire transaction. Now let's move to mixed supplies, where the approach is completely different. For mixed supply, there is no principal supply to guide us. Instead, we apply what's called the highest tax rate rule. According to Section 8, a mixed supply comprising two or more supplies shall be treated as a supply of that particular supply which attracts the highest rate of tax. This means we look at all the components, identify their individual tax rates, and apply the highest one to the entire mixed supply. Let's take our McDonald's combo meal example again. Suppose the burger is taxed at 5%, the fries at 12%, and the cold drink at 28%. In this mixed supply, since the cold drink has the highest tax rate at 28%, the entire combo meal will be taxed at 28%. Why does the law adopt this approach for mixed supplies? It's primarily for revenue protection. Since there's no clear principal supply and all items are equally important to the customer's purchase decision, the law ensures that the government doesn't lose tax revenue by applying a lower rate. The practical implication for businesses is significant. When designing product bundles, as we conclude our session, let me quickly recap the key topics we've covered today. We started with understanding that supply is the taxable event in GST and explored the three essential parameters for any transaction to qualify as supply. We then examined the concept of consideration and its various forms. We covered Schedule 1 activities that are treated as supplies even without consideration. Schedule 2, which helps classify borderline transactions as either supply of goods or services, and Schedule 3, which defines non-supplies or exclusions from the scope of supply. Finally, we explored composite and mixed supplies, their definitions, examples, and most importantly, their taxation rules. This foundational understanding of supply under GST will serve as the building block for all your future GST learning. Thank you for your attention, and I will meet you in the next topic.